Greetings to all the humanoids on Earth and to those extra intelligent aliens orbiting around this planet. You are in Istanbul right now. You are at Real Turkey Channel and my name is Atilla Yesilada. Today we're going to talk economics, Turkey's inflation armageddon, and how, despite rising inflation, Turkish lira will remain strong for at least another year. By the way, make my position clear and to explain myself that the title is not a clickbait, Turkish lira will remain strong means that the depreciation of Turkish lira versus the American dollar will be less than inflation. For instance, my forecast for next year's CPI inflation is 25%, but I forecast that the Turkish lira would only lose 20% of its value against the dollar. In other words, it will be stronger by roughly 5% against the American dollar. Really, Turkey is facing an inflation armageddon. Among G20 countries, we're head-to-head with Argentina, which is a basket case, despite Javier Milei's efforts. Both countries are at 33% plus some decimals. That's an embarrassment because I think the next country is Brazil with 8%. Turkey is generating too much inflation compared to its growth potential and actual growth rate, which is estimated at around 5% as of third quarter of 2025. Today's CPI data, roughly 3.5%, exceeded expectations widely. The expectation was 2.65, was even higher than the Istanbul Inflation Index. This is unusual. It very rarely happens. And most importantly, the incremental success against inflation since the beginning of the year stopped and annual inflation rose marginally. So why do I call this Armageddon? Well, first of all, monthly inflation of 3.5%. I mean, we live in Armageddon. But the second Armageddon is that today's data belies all the positive, optimistic statements by economizar Mehmet Şimşek, by Central Bank Governor Mr. Fatih Karahan, and our dear President Mr. Erdogan, who expects inflation to be below 30% at the end of the year. This is not going to happen. For inflation to be below 30%, in the last quarter of the year, Turkey must generate negative CPI rates, which is just not going to happen. I don't need to show you any proof. You don't go from 3.5% to negative inflation unless a meteorite strikes your country. Why is Turkey generating so much inflation? A, we have a structural problem with food. We simply don't produce enough for quality food production at affordable prices. Indeed, a separate food inflation index compiled by independent think tank TEPAV shows that food prices rose by 2.84% and the highest monthly rise of the last 16 months. As of September. This is obviously the main problem. The second problem is inflation expectations. They are sticky. Remember, whenever Fed cuts rates or talks about the future, it pays special attention to inflation expectations and essentially says as long as long-term inflation expectations are well anchored, we won't hesitate to cut rates. Now, I think Fed is making a mistake because it measures inflation expectations from market data, such as the difference between straight and inflation-protected government bonds of the same maturity, whereas a Conference Board and University of Michigan consumer confidence indices show rise in inflation expectations. But that's Powell's problem, or one of Powell's problems, who's also dealing with Trump, who mocks him at every occasion. In Turkey, inflation expectations are not only measured by private sector entities such as Koç University, but also by central bank's own survey, which asks the participants what do they think the inflation rate will be 20 months ahead. The latest data shows that private sector expects roughly 38% inflation in the next 12 months, whereas the households expect something over 50%. The data from Koç University is not much different. At least both are in the same direction, in the sense that a majority of participants, maybe 2/3, Jesus, Friday is a bad day, 2/3 don't expect inflation to fall within the next 12 months. The other problem is, of course, domestic demand is too strong. We don't know where the strength comes from in a country where poverty is becoming more widespread by the day. So much so that families who can barely afford food are withdrawing their children from mid-school education. 3 million kids cannot go to school this year simply because households can't even afford a simple item like stationery and school lunches. But according to an ING survey, 26% of the population is able to save, which means they have discretionary income, which they spend because they think interest rates are going to be lower, but inflation is going to be higher. So why not borrow now and spend it? Moreover, Turkey has a parallel economy, which is largely driven by money laundering, drug trading, and other illegal activities. In a recent crackdown, a company called Can Holding was taken over by the government and then turned over to Turkish Deposit Insurance Fund, which is running this holding company via a group of trustees. According to Turkey's OFAC, this company laundered $55 billion in the last 5 years. That's roughly $10 billion a year and 1% of GDP. Of course, this is additional spending that we cannot account for, and it keeps domestic demand extremely strong. So there is really, with the exception of global conditions turning to Turkey's favor, there is really no reason to expect that inflation will fall unless we tighten monetary policy, or more preferably, both monetary and fiscal policy. What can be a favorable turn of events for Turkish economy? That would be Brent prices falling further, which would not be surprising because according to some forecasts, there is a supply glut in Brent, and its price can fall to $50 by the end of 2026. Obviously, that would be great relief to Turkish consumer and the central bank, but you don't do central planning like that. Central planning is prudent, conservative, and doesn't rely on future forecasts of other variables. The main problem, as I've said, is that fiscal and monetary policies are not tight. There is really no hope that fiscal policy will be tightened in future years. This is not unique to Turkey. Nowadays, the budget mostly consists of wage and salary payments and interest payments, which are fixed. You have to pay those. This is why there is very little room to cut in the budget in terms of discretionary spending. And even that, Turkey is not willing to do, because inflationary spending from the budget is one way for Mr. Erdogan to feed his cronies. So fiscal narrowing is really not a feasibility for 2026. And the central bank committed a huge mistake when it started cutting rates again. Despite all of these, in October's Monetary Policy Council meeting, central bank will cut rates once again, and probably even in November. not because they are necessarily under the gaze of Mr. Erdogan. They are not directed by Erdogan, but there is something wrong with their inflation models, or perhaps they are tired of hearing corporates arguing about extremely tight financial conditions and the impossibility of borrowing from banks. I don't know what the real reason is, but the central bank will continue cutting rates. I hope that after today's data, they do things to dampen rate cut expectations by the markets, which are 250 basis points per meeting. I think in this sense, if central bank lowers rates by 100 basis points, it's going to be a positive signal that it's still fighting against inflation. Given the current data, another 250 basis point cut would be disastrous in terms of inflation expectations. Now, I have sketched a very gloomy picture for Turkish economy, in particular in terms of inflation. But what will happen to Turkish lira? Usually, when inflation rises and a country's central bank controls the depreciation of the currency, it ends up in a financial crisis. And it happened like that in the past, for instance, in 2001 and 2021, in Turkey too. But the world is full of austerity programs based solely on keeping the exchange rate strong, because eventually your trade account collapses and central bank reserves fall, and domestics start believing that a devaluation is imminent, thus immediately switching to hard currency deposits, which the central bank doesn't have the reserves to cover for. This will not happen in Turkey. As of last measure, Turkey's central bank has $180 billion in reserves. These are gross reserves because that's what counts when it comes to intervening in the currency market. The foreign financial investment in Turkey is estimated around $40 billion. It has not increased much during this year because of the political crises. In this respect, it's an advantage because the central bank can easily pay off all the hot money in Turkey if it comes down to that. The major problem would be domestics who have not changed the distribution of their deposit portfolios between FX and Turkish lira deposits. I'm fairly sure if central bank cuts interest rates, a portion of TL deposits will switch to real estate and even autos, which are considered investment goods in Turkey, and to FX. Nevertheless, to assume that over the winter period, when Turkey runs a fairly broad current account deficit, $100 billion, $120 billion of TL deposits switching to FX deposits. And once spring comes, tourism revenues come in and Turkey's import bill declines because we consume less energy, obviously, in the summer months. So under the most difficult circumstances, according to my calculations, the central bank can control the rate of currency depreciation. That's a dirty peg or crawling peg. And the central bank's policy is to keep the devaluation rate of Turkish lira against the USD dollar lower than expected inflation. So if I expect 25% inflation, as I suggested at the beginning, for instance, Turkish lira cannot depreciate more than 20% or so against the USD dollar, because this will help with disinflation in the sense that imported goods in Turkish lira terms would be cheaper. Given the fact that it has already committed itself to a monetary loosening cycle, that is rate cuts, which are inflationary in itself, and it's not getting any help from the budget, the central bank is now more committed than ever to the strong lira. Or put it this way, it's in a cul-de-sac, okay, one-way street. If you suddenly dispense with the strong lira policy, you get a sudden depreciation or overnight devaluation, which will immediately pass through to inflation. Let's say a 10% devaluation in Turkish lira overnight would add at least 3% to inflation 20 months or 12 months going forward. And the central bank cannot afford that. So, Turkey will remain expensive and even more expensive next year, but the Turkish lira is under no threat of a winter crisis. And this is really probably the only thing to be happy about the Turkish economy. This has been another broadcast of Real Turkey channel, and I'm your presenter Atilla Yesilada. Always grateful to our tiny community for their extremely enlightening and entertaining commentary. Have a good week.